下午好，
and
欢迎来
welcome
到今
to
天的
our
发
press
布会。
conference. I'm joined on stage by President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. As we are connected via video to some who are connected on screen, I would like to ask you to turn on your camera and your microphones if you ask questions later on. And with that, I give the floor to President Lagarde.
Thank you very much. So good afternoon. The Vice President and I welcome you to our press conference. Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the three key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target. The elevated level of uncertainty reinforces the importance of a data-dependent approach to our policy rate decisions, which will be determined by our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. The euro area banking sector is resilient, with strong capital and liquidity positions. In any case, our policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed, and to preserve the smooth transmission of monetary policy. The new ECB staff macroeconomic projections were finalized in early March, before the recent emergence of financial market tensions. As such, these tensions imply additional uncertainty around the baseline assessments of inflation and growth. Prior to these latest developments, the baseline path for headline inflation had already been revised down, mainly owing to a smaller contribution from energy prices than previously expected. ECB staff now sees inflation averaging 5.3% in 23, 2.9% in 24, and 2.1% in 25. At the same time, underlying price pressures remain strong. Inflation, excluding energy and food, continued to increase in February, and ECB staff expects it to average 4.6% in 23, which is higher than foreseen in the December projections. Subsequently, it is projected to come down to 2.5% in 24 and 2.2% in 25, as the upward pressures from past supply shocks and the reopening of the economy fade out, and as tighter monetary policy increasingly dampens demand. The baseline projections for growth in 23 have been revised up to an average of 1% as a result of both the decline in energy prices and the economy's greater resilience to the challenging international environment. ECB staff then expect growth to pick up further to 1.6% in both 24 and 25, underpinned by a robust labour market, improving confidence, and a recovery in real incomes. At the same time, the pickup in growth in 24 and 25 is weaker than projected in December, owing to the tightening of monetary policy. The decisions taken today are set out in a press release that is available on our website. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Turning to the economic activity first. The euro area economy stagnated in the fourth quarter of 2022, thus avoiding the previously expected contraction. However, private domestic demand fell sharply. High inflation, prevailing uncertainties and tighter financing conditions dented private consumption and investment, which fell by 0.9% and 3.6% respectively. Under the baseline, the economy looks set to recover over the coming quarters. Industrial production should pick up as supply conditions improve further, confidence continues to recover, and firms work off large order backlogs. Rising wages and falling energy prices will partly offset the loss of purchasing power that many households are experiencing as a result of high inflation. This, in turn, will support consumer spending. Moreover, the labour market remains strong, despite the weakening of economic activity. Employment grew by 0.3% in the fourth quarter of 2022, and the unemployment rate stayed at its historical low of 6.6% in January 23. Government measures to shield the economy from the impact of high energy prices should be temporary, targeted, and tailored to preserving incentives to consume less energy. As energy prices fall and risks around the energy supply recede, it is important to start rolling back these measures promptly and in a concerted manner. Measures falling short of these principles are likely to drive up medium-term inflation pressures, which would call for a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, and as stated in the European Commission's guidance of March 8, 2023, fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded rapidly. Let's look at inflation. Inflation edged down to 8.5% in February. The decline resulted from a renewed sharp drop in energy prices. By contrast, food price inflation increased further to 15%, with the past surge in the cost of energy and of other inputs for food production still feeding through to consumer prices. Moreover, underlying price pressures remain strong. Inflation excluding energy and food increased to 5.6% in February, and other indicators of underlying inflation have also stayed high. Non-energy industrial goods inflation rose to 6.8% in February, mainly reflecting the delayed effects of past supply bottlenecks and high energy prices. Services inflation, which rose to 4.8% in February, is also still being driven by the gradual pass-through of past energy cost increases, pent-up demand from the reopening of the economy, and rising wages. Wage pressures have strengthened on the back of robust labour markets and employees aiming to recoup some of the purchasing power lost owing to high inflation. Moreover, many firms were able to raise their profit margins in sectors faced with constrained supply and resurgent demand. At the same time, most measures of longer-term inflation expectations currently stand at around 2%, although they warrant continued monitoring, especially in light of recent volatility in market-based inflation expectations. Moving to the risk assessment now. Risks to the outlook for economic growth are tilted to the downside. Persistently elevated financial market tensions could tighten broader credit conditions more strongly than expected and dampen confidence. Russia's unjustified war against Ukraine and its people continues to be a significant downside risk to the economy and could again push up the cost of energy and food. There could also be an additional drag on euro area growth if the world economy weakened more sharply than expected. However, companies could adapt more quickly to the challenging international environment, and together with the fading out of the energy shock, this could support higher growth than currently expected. The upside risks to inflation include existing pipeline pressures that could still send retail prices even higher than expected in the near term. Domestic factors, such as a persistent rise in inflation expectations above our target or higher than anticipated increases in wages and profit margins, could drive inflation higher, including over the medium term. Moreover, a stronger than expected economic rebound in China could give a fresh boost to commodity prices and foreign demand. The downside risks to inflation include persistently elevated financial market tensions that could accelerate disinflation. In addition, falling energy prices could translate into reduced pressure from underlying inflation and wages. A weakening of demand, including owing to a stronger deceleration of bank credit or a stronger than projected transmission of monetary policy, would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's look at financial and market conditions. Market interest rates rose considerably in the weeks following our last meeting, but the increase has strongly reversed over recent days in a context of severe financial market tensions. Bank credit to euro area firms has become more expensive. Credit to firms has weakened further, owing to lower demand and tighter credit supply conditions. Household borrowing has become more expensive as well, especially owing to higher mortgage rates. This rise in borrowing costs and the resultant decline in demand, along with tighter credit standards, have led to a further slowdown in the growth of loans to households. And these weaker loan dynamics, money growth has slowed sharply, driven by its most liquid component. So summing up, inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the three key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target. The elevated level of uncertainty reinforces the importance of a data-dependent approach to our policy rate decisions, which will be determined by our assessment of inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We now stand ready to take your questions.
Thank you, President Lagarde. And the first question goes to Alex Weber of Bloomberg News. Alex, please.
Thank you. Good afternoon. I was wondering, could you explain a little bit how you see the path for interest rates ahead? I mean, until a few days ago, it seemed pretty clear that interest rates would have to rise further after this meeting, but you didn't give any guidance in the statement. Does this mean it could be that we've already reached the peak in interest rates? And then secondly, regarding the banking sector more broadly, a lot of people have drawn parallels to between what happened at Credit Suisse and Silicon Valley Bank and failures we've seen at the last financial crisis like Bear Stearns. Do you see any risks that we're on the verge of a systemic crisis like in 2008?
Thank you very much for your question. On your first question, I would call your attention to one particular paragraph, which is the first one in our monetary policy statement, in which we are really trying to dissect for you the mechanism of our reaction function. And this is really the best guidance that we can provide. And it is, number one, the assessment of the inflation outlook in light of the incoming economic and financial data. Number two, the dynamics of underlying inflation. And number three, the strength of our monetary policy transmission. So that's brand new. These three components, we never discuss them, we never let them out, and they are clearly identified as the three elements that will be taken into account to determine our reaction function going forward. Second point. If our baseline was to persist, when the uncertainty reduces, we know that we have a lot more ground to cover, okay? But it's a big caveat. If our baseline was to persist, as you know, the projection that were decided by staff, sorry, not decided, but determined by staff, are based on data and assessment of the situation with a cut-off date. And that cut-off date was February 15th for the international outlook and technical assumptions, and March 1st for the euro area macroeconomic projections. Now, since March the 1st, a lot obviously has developed. And the projections that we have do not incorporate any of the most recent development, and certainly not the impact of the most recent financial tensions that we have observed on the markets. So there is a level of uncertainty that has been completely elevated as a result of that. And that is the reason why we reinforce the principle of data dependency that we have indicated in the past with a clear map of the reaction function that we will have in the future. So it is not possible at this point in time, and on the basis of the first component that I have mentioned, which is assessment of the inflation outlook in light of the incoming economic and financial data, it is not possible to determine at this point in time, what the path will be going forward. But we know that it will be data dependent, and we know that if the baseline as we have it was confirmed and was to persist, we would have more ground to cover. On your second point, I will again read for you one more time what is in the second paragraph this time of our monetary policy statement, which is that we are monitoring current market tensions closely. We stand ready to respond as necessary to preserve price stability and financial stability in the euro area. And given the reforms that have taken place, and I was around in 2008, so I have clear recollection of what happened and what we had to do. We did reform the framework. We did agree on Basel III. We did increase the capital ratio. We did increase the financial coverage ratio as well. And I think that the banking sector is currently in a much, much stronger position than where it was back in 2008. Added to which, if it was needed, we do have the tools, we do have the facilities that are available. And we also have a toolbox that has other instruments that we always stand ready to activate if and when needed. And finally, and that's a tribute to our staff, because as you can imagine, we all have worked quite hard in the last few days, and particularly the last few hours. They have demonstrated in the past that they can also exercise creativity in very short order in case it is needed to respond to what would be a liquidity crisis if there was such a thing. But this is not what we are seeing. Thank you.
Thank you, President Lagarde. And the next question goes to, I'm now turning to remote participants, to Balazs Korani of Reuters. Balazs, please, over to you.
Good afternoon, and thank you for taking my questions. President Lagarde, could you unpack for me what you mean a lot more ground to cover?
Sorry, I missed the first part of your question. Balazs, can you repeat the first part? I missed it.
Yes. I said, could you please unpack for me your statement that there might be a lot more ground to cover should the baseline prevail? What does that mean? Especially given that prior to this meeting, almost all governing council members, including Philip Lane, has said that more rate hikes will likely be needed beyond March. So are you walking back on that commitment, or is the ECB's inflation fighting stamina waning? Are you giving up on inflation? The second question I have is the usual one, I'm sorry. What other options were being discussed in the meeting today? What were the alternatives that policymakers were supporting?
Thank you for your question. We are not waning on our commitment to fight inflation, and we are determined to return inflation back to 2% target in the medium term. That should not be doubted. The determination is intact, and the path at which we will cover the ground, the pace that we will take, will be entirely data dependent. That's what we have always said. And we are saying on this specific occasion that given the level of uncertainty that has been significantly increased as a result of the most recent financial tensions and developments, given that level of uncertainty, it is better to make the decision that we believe is a robust decision with our 50 basis points increase, and then see what the data tell us and what next assessment we make on the basis of that data. But let me reassure you, we are determined to fight inflation and return it to 2%. And we will take the measures that are necessary. They will be data dependent, and they will function on the basis of these three parameters that I have just mentioned to illustrate what our reaction function is. You had a second question, which you said was a repeat of previous questions, which I think had to do with any other options, what has happened behind those closed doors, and I fully appreciate the question. I have to tell you that the Executive Board proposed that option which is described in the monetary policy statement, and that no other option was proposed. I can also tell you that the decision was adopted by a very large majority, with 3 or 4 that did not support the decision, not in its principle, because they were ready to go for that decision, but they were keen to probably give a bit more time to see how the situation unfolds and what additional data we can collect. But otherwise, it was a very large majority decision. And I would say taken in rather record time. Thank you.
Thank you, President Lagarde. I would like to now turn to Kolja Ruzio of the German weekly Die Zeit. Kolja, please.
I would like to ask a question concerning the data-driven decisions. Isn't there a conflict of goals between price stability and financial stability? And to what extent do you consider slowing down the pace of rate hikes because of financial stability? Do you have to slower down, perhaps, because of financial stability? That is my first question. And the second, were you surprised by the financial problems we see now in the US, and we saw last year in the pension funds in the UK? Was this a surprise, or is it something which was expected perhaps by monetary policy experts?
Well, let me be pretty clear on that point as well. I believe that there is no trade-off between price stability and financial stability. And I think that, if anything, with this decision, we are demonstrating this. We are addressing the price stability issue by raising interest rate by 50 basis points, which is what we had intended, and because inflation is projected to remain way above our target and for too long. And separate from that, we also are monitoring market tensions. We stand ready to provide any kind of additional facilities if needed. We do have extensive facilities, more so, by the way, than the Fed in terms of size of the collateral pools and facilities. And we can do more if necessary. We have demonstrated that in the times of PEP. All the instruments that we decided in the PEP times, whether it is on the pool of collaterals, whether it's on the haircuts, whether it's on all issues, that can be reactivated like that. And we always stand ready to use them again. So, euro liquidity is perfectly addressed. No issue on that front. So there's no trade-off. We have to do our job. This is primary objective, price stability. And as I said, in the identification of the three components that will inform our decision, that will determine our reaction function, you find the word financial, if you look carefully. You have assessment of the inflation outlook in light of the incoming economic and financial data. So the financial issues are captured in order to assess inflation. So there is no trade-off. We have financial stability very much as part of our radar screen and the tools that we can deploy, but there is no trade-off between the two. Did you want to add to that, Vice President?
Well, first of all, good afternoon. Well, from a financial stability standpoint, and the perspective is quite clear. If you look at the industry as a whole, as the President has indicated before, the situation of the European banks, they are resilient. Capital is much higher than it was 10, 15 years ago, before the global financial crisis. The liquidity position of the European banks is robust. If you look at the liquidity ratios, on average, they are clearly above the minimum requirements and even the pre-pandemic levels. And even if you look at the composition of these liquidity buffers, they are high quality, very high liquidity assets. So in that respect, the composition is quite positive. And finally, there is something that I think that is relevant, is the increase in interest rates. Well, is positive in terms of the margins of the European banks. And this improvement in terms of profitability more than offsets, potential losses in fixed income portfolios. Looking at the exposure, for instance, to Credit Suisse, they are quite limited. And, there is no concentration. There is no a single counterparty that concentrates a large part of that exposure. And finally, as the President has indicated, well, we have a toolkit of instruments just in case that are needed in order to deliver liquidity.
Thank you, Vice President. And now the next question for Martin Arnold of the Financial Times. Martin, please.
Hello, President Lagarde. Could you just explore a bit more this potential for a trade-off between financial stability and price stability? Could you foresee a situation where, given the outlook for inflation, you need to raise rates further, but there's a risk that that could trigger a financial crisis or make a financial stress worse? Second question is that given that you've said the underlying inflation is going to be one of the key factors you look at when deciding, one of the three key factors, does that mean that until you see an easing of most of the indicators of underlying inflation, which you're not seeing at the moment, you won't be able to stop raising rates? Thank you.
Thank you, Martin, for your questions, the two questions. On the first one, as I said earlier, we don't see any trade-off between price stability and financial stability. And we will address each of these two with their respective instrument. For the moment, interest rate for price stability and the set of facilities that we have available, additional lines if necessary, including in other currencies if that is needed, in order to address financial stability issues. So they inform each other. I'll come to that in a second. But we handle them separately, and there is no trade-off between the two. It's pretty obvious when I say that the inflation outlook will be assessed in light of the incoming economic and financial data, that the financial data, whatever they are, will inform our assessment of inflation. So through that assessment, those financial data, we actually take into account development in the financial markets, financing, financial cost, terms and conditions, and the financing of the economy at large. Your second question had to do, if I recall, with my second. Sorry, wait a minute. I need to get back to my second item. Yeah, because you did refer to the key, but it's the second. The first one that we mentioned is the assessment of inflation outlook in light of economic and financial data, and it needs to be confirmed by the underlying component of inflation. And on that front, we are again going to be data dependent. And it is obvious that as long as we see underlying component of inflation going up, this is not going to stop our fight against inflation. So we will need to receive confirmation on the underlying component of inflation. We will need to receive confirmation that we are heading in the direction of our target of 2%. We are seeing some slight improvement in certain areas, but frankly, not a lot. And we know that whether you look at core, which is one of the components of the underlying inflation, or whether we look at, other dissection of inflation, and in particular when we look at services, it's not yet heading in the direction that would confirm the inflation outlook that we have.
Thank you, President. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. Good afternoon. My question
Good to
is...
see you in real life, not on screen.
Thank you. My question is on the mentioning of monetary policy transmission, which comes in your decisions in the three points that you said about explaining your reaction function. So one of them is the monetary policy transmission. And also at the end of your decisions, you mention that the Governing Council is ready to adapt and adjust your instruments to preserve also the monetary policy transmission. Mm-hmm. So we think about TPI when we hear mm-hmm. about this. Mm-hmm. I'd like to know whether you think that TPI can be used when banking tensions start to jeopardize the transmission of monetary policy. And whether in your fully equipped toolkit, you could also consider to adjust the pace of the reduction of the holdings of securities under the asset purchase program, so the QT.
First of all, on monetary policy transmission, I will be giving a speech soon about monetary policy transmission and about the first leg of monetary policy transmission and the second leg of monetary policy transmission. All I can say at this point in time is that we're beginning to see transmission of our monetary policy through the credit channel. And if you look at rates, if you look at terms and conditions, if you look at the impact that it has on the demand of financing on the part of both corporates and households, we are beginning to see transmission of our monetary policy, which is really what we expected. TPI transmission policy instrument was precisely designed to make sure that monetary policy would travel and move all the way to all members of the 20 member states. To all 20 members of the euro area. And that would be caused by factors that had nothing to do with the fundamentals of an economy or its general macroeconomic policies. We have not yet had to decide whether financial tensions would qualify in that respect, but it could well be the case. I'm advancing a little bit because we did not discuss that at all, and it's something that would need to be debated with the Governing Council. Nor did we decide anything on the partial reinvestment under the APP. That's a principle that we decided back at our February meeting, which has been in place now as of the 1st of March, and that will continue to unfold in a regular and unimpeded fashion.
Thank you, Madame Lagarde. Turning back to our remote participants, I would like now to give the floor to Jean-Philippe Lacour of Agence France-Presse, AFP. Jean-Philippe, please.
Yes, now you can hear me and see me, I hope.
Yes.
Okay, good afternoon, Madame la Présidente. One question on these underlying components of inflation you mentioned. Do you put the significant contribution of profit margins into these components? Because the profit margin seems to develop well, and that could maybe put some questions on the narrative of the ECB, very focused on the risk, either on the wage price loop. And I would like to hear what you think about this contribution of corporate profits to inflation. And a second question, if I may. Mr. Guindos, you are quoted that some banks may be vulnerable. You would have told this to ministers briefed earlier this week. I don't hear this today in your statement. Maybe you can precise or confirm or not what has been reported. Thank you.
Thank you very much for your two questions. And I just want to go back to the statement. I just want to find the right sentence where for the first time actually we talk about margins. And it is, must be in the inflation sections. Anyway, I'm not going to waste your time trying to find the sentence in which we, oh, here it is. So moreover, many firms were able to raise their profit margins in sectors faced with constrained supply and resurgent demand. So we mention it very specifically. It is part of the analysis that we conduct. As has been mentioned by some of you who are following us very carefully, we had a retreat of all the governors of the Governing Council to discuss in depth various matters, one of which was actually the various components that fuel underlying inflation, and we did have some assessment of the increase in margins by the corporates, which played a role. I'd like to say one thing, because there has also been reference to the fact that I would have mentioned the word wages X times during my last press conference. I think what we hope for is a proper burden sharing of what really is a quasi-tax. This cost-push shock has been operating a bit like a tax, at least in portion of its form, and that this tax should be shared because there has to be some burden sharing. What we are concerned about is whatever the burden sharing, if that was to spiral into the second round effect that we don't want to see, frankly. But this burden sharing aspect is something that needs to be debated at society level, at corporate level, and is certainly something that we would welcome to the extent that it reduces the risk of second round effect in particular. On the other question that you asked pointedly, I also want to point to you the sentence which is in the second paragraph of the monetary policy statement, and as you know, the first paragraphs matter. And in there, we say the euro area banking sector is resilient with strong capital and liquidity positions. And we stand by that statement strongly. But I will let you, Vice President, comment on this wonderful leak.
As you can imagine, I remember what I told the ministers, and it's almost identical to what I have just told you. So that the banks are resilient, high capital ratios, robust liquidity buffers, high quality of the main components of the liquidity buffer, limited exposure to the institutions of the US in that case, because it was last Tuesday of the US, and simultaneously that the overall assessment was quite clear. So that the banking industry in Europe is resilient.
Thank you, Vice President, Madam President. Next question goes to Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madam President. When you talk about creativity of the staff, do you think that if needed, the ECB could come up with a tool like the one presented by the Federal Reserve, accepting bonds like at par instead of market value, or would it face legal constraints? And I have a second question, if I may. You have visited Spain recently, and I'm sure you are aware that there's a concern about the low remuneration on deposits there. Banks say that this is because they have plenty of liquidity from the ECB. So I was wondering if you think that the low deposits are going to continue until TLTROs mature, or it is something different and you are not in the same point as the banks. Thank you.
Well, thank you. Thank you for your two questions. So when I say that I have full confidence in staff creativity, what I mean is that I have seen them in action. They've been there, they've done it. And on the occasion of COVID, for instance, they were able in very short order to put together programs that proved extremely efficient in order to resist the downside effect of the crisis. So those tools exist. They are strong, they are powerful, and they can be reactivated anytime. We always stand ready to do that. Added to which the facilities that we have currently are probably broader and more accessible than the ones that pre-existed at the Fed. So I don't see the need at this point in time to explore any alternatives to the tools that we have, because I think that they function. If it was needed at some point in time, of course, I know staff will stand up to the occasion and will also look at what can be done within our mandate and in accordance with the rules of the treaty under which we are governed. On the issue of remuneration of deposits, I have spoken my mind on Spanish television, and I have observed that in quite a few countries now, the DFR is taken into account in order to determine the rate at which deposits are remunerated, either deposits at sight or term deposits. And that, obviously, this is something that needs to be debated between the clients and their banks. But I observe that there are quite a few countries where banks actually do that, and competition between them is facilitating that process.
Thank you, Madam Lagarde. The next question goes to Eshe Nelson of the New York Times. Eshe, please.
Hi, good afternoon.
Good afternoon.
You I would like to go back to this point about the incoming economic and financial data. I mean, in the past meetings, we've heard a lot about what the economic data is, the underlying inflation data. Could you detail a little more what the financial data is that you'll be watching? And is there a new emphasis on this data, or has it always kind of been there? And then my second question is, how much has the volatility we've seen in bank stocks recently as the meeting was happening affected today's decision, not necessarily the interest rate decision, but the choice to not kind of lay the path ahead more clearly? Thank you.
I like your last word, clearly. This is something that we are longing for, clarity. Because obviously we work on the basis of data, of observations, of facts. And there is currently, for the reasons that I have mentioned in my monetary policy statement, a degree of uncertainty that pre-existed, but that has certainly been amplified by the most recent financial tensions that we have observed in the last few days. So that has, you know, it's obviously difficult for a group of 26 members of the Governing Council to come to a decision in the face of projection and the first of the three elements that I have mentioned to determine our reaction function, to come up to a decision. But we were certainly confident that this 50 basis points rate increase was a robust decision, considering the ground that needs to be covered. What financial data do we look at? We are particularly concerned, obviously, about our monetary policy transmission. So we look very carefully, using various analytical tools. We look at credit to corporates, credit to households, terms and conditions, restrictions eventually, if they were to be observed, to assess whether the financial conditions are tightening and what impact this tightening of financial conditions will then have on the economy. Those are the key components that we assess to determine our monetary policy transmission.
Thank you, President. And the next question, going back to our remote participant, goes to Tom Fairless of the Wall Street Journal. Tom, please. Tom, can you hear us? This does not seem to be the case. Then I would give the next question to Eric Albert of Le Monde, also connected via video call. Eric, please.
Good afternoon. Thank you very much for taking the question. There's been a lot of parallels done with 2008. Obviously, the banks are in different circumstances, but in July 2008, the ECB increased an interest rate, did an interest rate hike just 2 months before the biggest financial crash in recent history. Is the ECB at risk of doing the same mistake? First thing. And the second question is about the transmission of monetary policy. It takes a long time for interest rate hikes to go through the economy. Given the uncertainty, isn't there a case for at least slowing down? You said you were data dependent, but isn't there a case now to slow down in the next few meetings?
Thank you very much for your two questions. As you said yourself, the banks are in a completely different position from 2008. And, you know, crises are never exactly the same anyway. But the architecture of our banking system, the framework within which they operate, the supervision that is applied to the banking system have been all considerably improved. So, obviously, we're mindful of our history and what has been done in the past, but we are all confident that the decision that we made today is a robust decision, was called for, was needed, and we have, as you have noticed, I'm sure, indicated very precisely that as to the future, we would be data dependent. And that, I think, is predicated on the fact that we need to have a better assessment once the financial tensions on the markets abate in the future. On your second question, we are seeing we're beginning to see a good transmission of our monetary policy in the credit sector, as I have mentioned earlier on. I think we have seen a reduction of several basis points, 20 to 16 basis points, depending on whether you look at corporates or households, increase in the credit rates that are offered, and a significant tightening on the part of the banks that are probably assessing and reassessing the risks that they're taking. So this is, in our view, the beginning of an indication of good transmission of monetary policy. This is not the end of it. As you said, it takes a longer time. It seems to have transmitted rather rapidly, if you consider that we decided to normalize our monetary policy back in December a year ago, so it's a little over a year ago, and we are certainly beginning to see in the credit segment the impact of our decisions. Are we seeing dampening demand? That remains to be seen, and how much more does it need to be dampened in order to meet the objectives that we have, which is 2% medium-term target, to be seen. We are data dependent. We're going to really look at the uncertainty fading out, hopefully, and what projections we will be able to operate upon, as well as what assessment we can make at our next policy meetings in May, June, and subsequently.
Thank you, Madame Lagarde. Let's try again with Tom Fairless of the Wall Street Journal. Tom, can you connect?
Hi, can you hear me?
Yes.
Okay. So thanks so much for taking my question. I suppose the first question is, we've started to see these signs of weakness in financial markets, and you haven't taken that as a reason to pause. But is there, do you think, a message in what's happening? It's something that we haven't seen for a while, and that has reminiscent, it kind of brings back memories of maybe to the financial crisis, as other people have said. I mean, is just the unusualness of this a reason to kind of think twice about future rate increases? Do you think, with this phrase that we hear, raise rates until something breaks? And my second question was related, that at the moment the bank failures were in the US. Do you think this is more of a US specific issue? Do you think there's something fundamentally different about Europe that means European banks are less vulnerable, or maybe the level of your policy rate means they're less vulnerable? Thank you.
Thank you very much for your two questions. On the first question, I would like to just reiterate our confidence in our banking sector. As I said earlier on, it's a banking sector that is resilient, that has strong capital and liquidity positions. And we are monitoring the particular situation, and we are monitoring the market tensions, and we stand ready to respond with all the tools that we have that can be switched on, and by any tools that would need to be applied to the situation depending on the circumstances. So it's not business as usual, but we believe that the decision that we have taken is robust, is completely justified by the circumstances, and informed by our current analysis. Is it a US-specific problem? We are all governed by, the banking sector is governed by Basel III, and banks operate within the framework of Basel III. As you know, there have been multiple discussions and disagreement as to who applies Basel III better than the other. But I would simply observe, because comparisons are pretty odious, that in Europe, we have strong supervision, we have strong capital, and we have solid liquidity positions. And as the Vice President said, exposures are not concentrated. And based on the work that has been conducted by the SSM, we don't have similar occurrence as the one that occurred in California, for instance. But maybe, Vice President, you want to add to that?
Well, perhaps, the only thing to add is that the business model of the Silicon Valley Bank was quite unique, and that it was, there was a mismatch between the assets and the liabilities that, it made this bank vulnerable, and this has been indicated by the American authorities, to any important change in interest rates.
Thank you, Vice President. And the last question today goes to Leonidas Exousidis of Handelsblatt. Leonidas, please.
Thank you. Good afternoon. I have a question concerning the excess of liquidity and the ECB balance sheet. Did you discuss about an increase in the level of reduction? And if yes, when could this increase start? Thank you.
Thank you so much. You give me a chance to be very brief in my response. No, we did not discuss. We had plenty to discuss today, and we did not discuss that particular one. Thank you so much.
This concludes our press conference. Our next press conference is on the 4th of May. Until then, all the best and have a good afternoon.